Hello, thank you for attending today's webinar, Looking to 2024 Market Volatility Surrounding Valuations of SaaS Companies. Before we get started, I just want to help frame the bigger picture around the reasoning why we offer so much great content, education, and timely insights for free. Maintaining profitability, remaining compliant with changing regulations, and embarking on digital transformation are just a few challenges your organization may be facing right now. With competing pressures and priorities, market volatility, you're likely facing more challenges than ever before. In today's world, you need a partner who's just as vested in your success as you are. You shouldn't have to face your biggest challenges alone. These challenges require a special type of thinking, industry experience, technology solutions, and trust. Armanino wants to be your partner and redefine what's possible for your organization. Today, you'll get some insider experience on what we can deliver and see what the future could look like for you. Before we get started, just a quick note that this is a Zoom webinar. Should you have questions throughout, go ahead and use the Q&A box or chat. We will be taking questions at the end of the webinar, should that not be covered throughout the content. And additionally, if you have need any assistance, go ahead and raise your hand and I will connect with you privately as soon as I can. With that, just to give our speakers an idea who is joining us here today, we're going to do one quick polling question. It's not required as this webinar is not for CPE. However, I do want to make sure that we capture as much of this as we can and that they focus the information on who's actually joining us here today. So, and select what is your company's latest funding series? Pre-seed, seed, early stage, late stage, private equity backed, public, or other. I'll leave this open just for a couple more seconds. I know some people are still trickling in to join the webinar today. Okay. Great. All right. Very small group here to start, Jason and Scott, but looks like we've got a pretty good mix of pre-seed, early stage, and late stage. Okay. With that, I would like to pass this over and introduce one of our first speakers, Jason Woon. He is a partner in Armanino's CFOA, our CFO advisory group, with specializing in the valuation services. Jason?
Thanks, Alexa. Yep, as Alexa said, I'm a partner leading our valuation group. Prior to joining Armanino, I also spent time at SoftBank at the Vision Fund, and was also a director at Coinbase Ventures, so investing in early stage crypto companies. I'm joined by Scott Schwartz. Scott, you want to introduce yourself?
Yeah, thanks, Jason. Partner here at Armanino. Been here for about 13 years. Work with Jason in the CFO advisory umbrella, as well as focusing on all things within the technology industry. So we're excited to have everybody here. We're gonna kind of dive right in. We're going to be covering the market kind of VC trends, look at kind of what investors are considering, and then talk some about impacts on valuations. We appreciate those folks that did ask questions. We're going to try and address as many or all those questions as we can. And then even questions that come in, again, we're going to try and cover what we can live, but we'll definitely make sure to follow up if there's questions that we do not get to. So talking about kind of current U.S. funding trends, no surprise, everybody's talking about kind of the decline in deal flow. I was a little surprised that it's even kind of going all the way back to Q2 2018. Additionally, kind of values, so not just count of deals, but the values have kind of gone down, to their 2019 level, which makes sense if you think about the influx and inflated values that we had in 2020 and 2021. I think that sort of aligns with those expectations. Definitely a difficult time to raise funding, and we're going to talk more about some of the trends we're seeing in the funding market. Jason, maybe you want to talk about some of the things that we're seeing in the challenges of getting funding?
Yeah, I know 100%. I mean, even I saw my time at SoftBank that, investors are just getting, they have a higher bar these days. They want to see things like traction as opposed to hopes. And so we're seeing harder time raising funds. We see a lot more extension rounds, but also some alternative sources of financing, venture debt, and convertible debt. So you may be able to raise money. It just may not be at the terms that you were able to a couple of years ago.
Yeah, I think much more stringent structural terms. Not surprisingly, right? AI, everybody's talking about AI. What is, I think, a little bit of a nice trend if you're environmentally focused or focused on the planet is, climate tech, clean tech. There's been a little bit of an uptick there, and life sciences kind of garnering a larger percentage of the relative kind of market of deals, right? From an absolute percentage, all deals are kind of down, but as a relative to the overall, sciences is a little bit up. And flat rounds, Jason talked about that, and we're still seeing some down rounds as well. Still seeing clients doing repricings and things like that. So that's kind of the state of the market as we see it today.
And before you move on, I think, Scott, I think down rounds are okay, right? Flat is the new up, if you will. Nothing bad to be flat or a modest higher. And down rounds present some opportunities for employees to receive refreshed stock compensation. And again, I think raising money is still better than not raising money these days. And then just one other bullet point on here, we said investors are focusing on their existing portfolios. I think just given that the deal count has fallen, I think a little bit more attention, VCs especially, and private equity for that matter, are spending time with their portfolio companies and trying to help them operationalize some things more.
Yeah, and there was a question, I think, around profitability. That, again, it depends on the stage you're at, right? I think there's always a balance to growth and profitability. But there is a renewed focus on, that path to cash flow positive or path to profitability, depending on what stage you're at. Although, again, I think that's that tricky balance that companies face of still having growth while also trying to achieve some level of cash flow positive. When we look at the next slide, we kind of talk around across the stages. There's actually been again, this graph is looking at comparing to 2021, sort of at the base as 100. Seed rounds, deal sizes have risen significantly. Again, this is influenced by the large institutional investors that came into deals. We're seeing a little bit less institutional in the seed round, but there was a sort of a realization that the returns for seed rounds can be strong even for institutionals, right? I think historically you had pretty much niche funds or smaller funds that were focused on the seed and pre-seed. Now you're seeing much larger institutional investors participating. I think we also have to recognize the AI buzz is a little bit of a skew too in the seed rounds. But they're holding strong. I think if you look across early and late stage, again, I think there was a huge influx of deal size, and there's a little bit of a returning to the mean, I would say, from a pre-pandemic perspective. And Jason's also going to cover public company multiples. We're going to talk about that. We have a slide that kind of covers some sort of valuation comparables on the public company side in a few slides. When we look at kind of pre-seed and seed, we actually, we just saw the average deal size increase relative to Q1 2021. In general, like the entire market, seed is still down, right? We're seeing seed sizes like pre-seed about $1 million, kind of the true seed maybe around 3 million, that $1 to $3 million range. But interestingly enough, again, this is skewed by large investors. So large investors, they're asking to take a larger equity stake, a larger percentage of the company, and they're pushing those rounds to around 5 million plus. So it's kind of that double-edged sword. If you're able to garner the attention of a larger investor in your seed round, then you can drive a higher valuation, up to 50, 60% higher in some cases. But on the flip side, right, they're taking a larger percentage of the company as well, right? So there's kind of that balance in the seed stage. That being said, if we look across seed, early stage and late stage, I think it's the best time to be a seed stage company compared to the other stages. Jason, thoughts on that?
Yeah, and exactly. I think that makes sense because there's a lot. It's much easier to raise money at the seed stage for a GP as well, right? It's much easier to raise a fund when you're raising $20 million instead of 200 or $2 billion or more. And so, there's a lot more capital that can be deployed, relatively speaking, for seed stage investments. And then I guess one other thought is if the seed investor has a 10-year horizon, they have a much longer time frame in a different economic cycle to get returns. Whereas late stage investors with valuations down, it's going to be harder to get their returns expected in a handful of years.
Yeah, we are starting to see, kind of to the point of the smaller funds, I think a little bit of a return to kind of smaller funds kind of carrying the day for seed. I think we saw an influx in 2021, 22 even, and still seeing it in 23, but there's a little bit of a return to kind of the smaller funds carrying the day for the seed. When we talk about early stage, Jason alluded to this, seeing a lot more extension rounds. Let's go to the next slide. So not surprisingly, when you see an extension of rounds, you're going to see kind of that flattening of valuations. I think there's also, we have to rationalize a return to kind of pre-pandemic levels or maybe early pandemic levels. So that being said, while we're seeing a flattening of valuations, we're also seeing deal values, they're kind of on pace to hit, potentially hit a 6-year low. So that's something to be sort of aware of. I think this also speaks to the shift from growth at all costs that we've been talking about, the market's been talking about, to getting to operational efficiency, right? I think early stage companies today, as opposed to in the past, there is that focus on getting to more operational efficiency. And I think there's also still, again, in talking to founders and talking to investors and seeing things in our clients, I think there's still a little bit of a disconnect in valuation expectations between founders and investors as well. That correction, that valuation correction and reset that we were talking about, I think it's still happening. It's continuing to happen. Anything you want to add there, Jason?
No, I think I'm going to cover a few more things in a subsequent slide. So
Perfect.
We can go next.
Talking to the late stage, again, this I think is the most obvious of all the kind of data. Valuations have really come down. They've come down to 2019 levels. And this does not surprise us. There's been a significant reduction in kind of the quote unquote mega deals. And mega deals skewed the valuations up. And now they're not happening as much and kind of skewing the valuations down. I think the other side of this is that the later stage companies, they had more cash. They raised a significant amount of cash in the boom. So they've been able to extend their runways, and they don't necessarily need to raise new rounds. So I think that's kind of contributing to both of the decline in value and decline in number of deals. This is going to cover some topics on the public company side and what we're seeing on that side now.
Yep. So if we go to the next slide, we focus on publics a little bit because we can get definitive data. Private companies, especially on the enterprise SaaS space, will maybe revenue is a trailing indicator as opposed to looking at a metric like ARR, and it's just much harder for comparability. But I think if you just look at the top graph here, you can see that there's a little bit of a dip. And this is just over the past year or so, a little bit of a dip earlier this year in terms of public multiples, but there's a sort of a steady slight upward trend here. I think these are last 12 months or trailing multiples here. If we look at forward multiples, you would probably put 10 to 20% off of these from a turn perspective. But I mean, just looking at profitability measures here on EBITDA multiples, you can see a little bit of a decline. And I think that's impacted a little bit, especially in the public markets, by the interest rate environment now. If we kind of just maybe stay on the slide, but if I was just talking to a founder this morning, and he was saying back in 2022, kind of the middle of the year, he was talking to raise a Series A investment at about 25 up to 25 times revenue, or I guess it was ARR for him. And the deal actually fell through. He was raising the Series A round, and he then wasn't able to raise as much. And nowadays he could probably only raise at 10x or something, and the terms are much less favorable. Let's put it that way. So just kind of goes to show that times have changed. And if we go to the next slide, I think this will just show that 2020, 2021 was really an abnormal time period. And so 25x again versus 10x is still very drastic in terms of a change, but it's almost this reversion back to the mean. If you look at these different economic cycles over the past 10 to 12 years here, we're in a period where we're kind of right in the middle here.
Yeah, and I think that's right, Jason. The other thing to note, right, is that the most recent period, a lot less activity, of course, right? That 5x is based on still seeing a couple hundred deals over the last 2 years, or a couple hundred IPOs over the last 2 years, but significantly down from kind of the peak.
Yeah. And if we want to go to the next slide, we pulled some data from private markets index called Forge Markets. And if you aren't aware of Forge Markets, it's a place where accredited investors can go and buy shares of private companies. These tend to be later stage private companies. So think your household unicorns, if you will. So they do an index of their maybe 100 companies that you can go buy and sell. And over the past, this is a 3-year look back here. Valuations are still up 28% overall. This year, though, just for 2023, enterprise SaaS is down, you can see 28%. That compares to 18% down for all companies in their index here, in the private markets index. And
I think.
Go ahead, Scott.
I was just going to say, in comparing, just for context, right, and compared to the public markets, if you look at the NASDAQ QQQ, over that kind of the same period, it's up 37%. So, although the IPO, sort of index is down 40%. So, but that's just kind of a comparison. Again, 28% return, I think, over those 3 years, maybe that's an acceptable return. But I think it's, again, kind of getting back to the mean, I think is a little bit the story here.
And it's not all doom and gloom, because if you go to the next slide, there's one benefit is there's now a backlog of likely IPOs. There's over 130 IPOs thus far in 2023. I mean, these are not all venture-backed companies. These are not all in the technology space or enterprise SaaS, but there's still over 130 IPOs in the US this year alone. Yet that's still relatively low compared to some of the historical standards. And the way to interpret this graph is that anything below the line is public listings pulled forward. Anything above the line is a so-called backlog of public listings. And so, I think, me personally, I think Q3 of next year is when we'll start to see the IPO market start to take off again in earnest. I know, Scott, you have maybe a different view. Do you want to share a little bit?
Yeah, I'm a little bit more optimistic, although slightly disappointed in kind of the October IPOs. But I'm a little bit more optimistic. I think we're going to start seeing some deals come through in Q2 and even maybe late Q1. You kind of got to close the books and refresh the S1 equivalent, 10K equivalent. I don't know. I believe we'll see some deals or some IPOs here at the end of Q1 into probably definitely in Q2 is my perspective. So we'll see. Coming to the next slide, talking about kind of SaaS a little bit more specifically. Again, I think it follows the trends of the market as a whole. One of the interesting things is kind of the allocation of of deals across the various stages. You've actually seen a decline kind of on a relative basis in the pre-seed and early stage. And again, I think some of this has to do with extensions that have been done in the late stage as well as the venture growth stage. That's kind of my personal theory behind that. For the sake of time, let's jump to the next slide as well. Again, I think this has to be taken with a grain of salt. So we focus usually on median multiples in general, because you can have large deals that skew and become huge outliers. I think that's what you're seeing in these two graphs, right? Mega deals. So you think about OpenAI, Anthropic, etc., as kind of significant deals that are skewing the average. When you look at the median, again, it's pretty much in line, slightly down, but still up, right? When we think about enterprise SaaS, we're in a SaaS drought for the last couple of years, but overall, we're still up, right, significantly from where we were in 2019 across both deal sizes and kind of valuations as well. So,
and I think there's a lot of optimism still on SaaS companies, whether it's enterprise or some sort of consumer focused SaaS, which is rare, but I still think there's optimism by venture investors. Bessemer Venture Partners is one, and they publish a nice report on the state of the cloud, and that's mostly SaaS companies, and they're still very bullish, and they're a big investor. I mean, I was talking to Minda Brew. She's a founding partner of First Row Partners, and they're kind of early stage pre-seed seed investor. And she was saying the benefit of SaaS companies is that they can cut, if you need to, sales and marketing. You can cut product expense to just hold on. If you've got recurring revenue, you've got a product that sells, you can kind of hold on for brighter days if needed.
Yeah, I think that's a great outlook. Let's jump to the kind of next slide. And we talked about this a little bit at the beginning. I think there is a transformation and kind of continued focus on improvement of people and planet, right? Again, clean tech, life sciences seeing an uptick. Even when we think about the AI and some of the disruptive technologies there, I think doing AI for quote unquote good, I think you're seeing trends there. Other things like platform companies, right, that are redefining and creating a platform for the marketplace. On the seed or Series A, I think the operational efficiencies is still a key piece of this. Definitely, as we alluded to, it's easier to raise a seed round right now than it is a late stage round. And if you have a scaling business and a addressable market, right, total addressable market, then I think you're seeing opportunity for investment. I mean, I was just looking at deals that were done, even yesterday. I mean, there was 10 or 12 deals announced just yesterday across the seed to really kind of the early stage, not any late stage rounds. So deals are out there. I think, again, it's this idea of coupling growth with operational efficiency, and the rule of 40 kind of being the North Star for companies. Again, at that kind of early to late stage in particular, not necessarily at the seed stage. And then I think we're seeing, higher valuations if you have that path of profitability, if you've been able to maybe bootstrap and get, use seed to get to cash flow positive. I've actually talked to more companies that have done that. So they're delaying maybe raising that Series A, or maybe not even raising it. I think those are kind of some of the key opportunities there that we're seeing in the marketplace as far as kind of VC requirements. I think growth is still a key thing. So a lot of people talk about profitability, but profitability without growth, I think that's a losing strategy. I think you have to have growth, and you may even be able to sacrifice some level of profitability or cash flow positive to make sure you're investing and you're continuing to grow.
And I think that's where you said like the rule of 40 comes in hand. I know that we had a question submitted beforehand about considering some metrics, even the rule of 40. And for those of you who don't know, it's a common KPI that investors look at when looking at growth. So top line growth as well as margins. And so the combination of the two should equal or really exceed 40 when added together. So you have to balance growth. It could be double digit growth, but it could be single or double digit negative margins, right? So you got to balance that as well. So I think those KPIs are still important, very important. In fact, more important these days. Other metrics like LTV to CAC and looking at some of the payback periods as well. I was talking to, again, Minda at First Row Partners, and she was saying that from her view, she invests in not in products. She invests in business models. So what's the vision? What's the story that you as a founder or management team can tell in the business model? Like, how can you gain outsized velocity and traction? It's not in the products, because you can change your products if you've got a strong business model and management team here. And then funny story, I guess one thing to wrap it up is who's receiving funding, and what can you do as a company to get a higher, maybe not higher valuation, but more focus. I was joking with some folks, and it's just change your company name to .ai or something to that effect, because AI really is an outsized focus area for investors. Whether it's a bubble or not, fine, but there seems to be a lot of bullishness there. And so hopefully, you're at least thinking about AI, because that could be coming up. And I guess one final thing is, I was talking to one company yesterday who just raised a seed round, and they're looking for Series A. Even their investors are asking for audited financial statements in a year at that very early stage as well. So again, some of these operational metrics are becoming, even more in vogue right now.
Yeah, Jason, we got a couple questions about I think deals, more M&A related questions on the valuation side, or what can you add back versus kind of one-time costs and things. In my experience, I don't think that's changed that much. I don't know that the industry has really changed that much. Maybe a little bit more stricter on analysis, but what's kind of your thoughts, perspectives on that?
Yeah, I agree with that. I mean, I think to people who ask the questions, there's a couple different ways to think about valuation. It's what we debated, right? There's your 409A valuation, there's a venture investor, and there's maybe a private equity or strategic acquirer too. And I think when you're thinking about like the latter, looking at quality of earnings and add backs and pro formas, things like that, those investors are really going to pay attention and scrutinize to the nth degree. When we're thinking about your 409A valuation, I mean, stock comp is certainly a thing that's probably not added back, actually, from the valuation community. That is an adjustment that is left in the P&L when we're valuing a business. And from a venture investor side, I think that's everyone's got stock comp, and if it's not out of the ordinary, then I think it's just a known thing, and I don't think it's as much to worry about as well.
Yeah, I think there's different philosophies on that. I think Warren Buffett is the most outspoken that we shouldn't be removing stock comp. I think in the public markets you do see it sometimes removed, but I think to your point, Jason, if it's comparable, it's comparable, and it's kind of an apples to apples thing, right? You include it for everybody, you remove it for everybody. What's the difference in some ways in that vein?
We had one more question as well about what about, is valuation still cookie cutter based on revenue or EBITDA, and is there any value associated with intellectual property like patents? I think that was an interesting one. I mean, just a real quick wrap up. I mean, revenue, EBITDA, fine, but again, that's public markets. Other metrics like ARR is important too. And then intellectual property, I'd say early stages, but there's probably a bigger focus on intellectual property and valuations these days. There are some companies who are willing to lend against intellectual property and underwrite and allow you to monetize it as well. So I know we have a minute left. Maybe Alexa, I'll pass it over to you. I think we got another couple questions. We're happy to follow up with individuals separately.
Absolutely. Thank you so much, Jason and Scott. That was great information. Everyone, just as we wrap up here today, just wanted to connect with you regarding next steps. Should you have any questions that weren't answered here today, or you're just interested in learning more and connecting with Armanino's tech experts, go ahead and drop your answer in here. I'll leave this open here for
And there was a question.
seconds.
There was a
Yes,
question
there
that
was
came
a
in.
question. Yep. Go ahead.
Sorry, if audio was out and I slurred, but LTV to CAC and payback period, other metrics like that, not less important and more on the contrary, more important these days. Sorry if there's any confusion there. And there's just
I don't think the rule of 40, just to clarify, I don't think the rule of 40 replaces those metrics. Right? It's those are still very important metrics. The rule of 40 is becoming a more important metric. So it's an and there, right? I think the focus on broader KPIs and more KPIs, right? Maybe more than just ARR, but looking beyond revenue at other metrics, like LTV to CAC and payback. I think that's kind of the trend that we're seeing and the focus of investors. Thanks, everybody. Appreciate it.
Thank you so much. As I said, if you'd like to connect further, feel free to reach out to us at experts@armaninollp.com. You can also connect with both Jason and Scott on LinkedIn. They're very responsive and would be happy to assist you in any way. With that, I just want to thank you all for attending. We hope you feel motivated and empowered to tackle today's challenges as well and reimagine what's possible for your organization. So we're here to be your insightful and integral partner along your continued business journey. With that, thank you so much. Have a wonderful day. Bye.
Thanks, everyone.